Hello student, welcome to the lecture on management of earnings and dividend policy. And after this lecture, we will be able to learn the following objectives. Understand the concept of dividend theories, explain the approaches to dividend policy, discuss the factors determining dividend policy, explain the types of dividend, understand the deciding the dividend payout ratio. Earning management and dividend policy is among the popular topics discussed in today's modern business. Earning management is manipulation or control of companies' financial income. If there are no investment opportunities, then it is the responsibility of management to distribute those funds as dividend. Earning management is a method which is used by management of a corporation to smooth their earnings. Dividends are paid by companies to their shareholders, members. When companies earn profit, they pay a portion to their shareholders and remaining is kept by company as retained earnings. Earning management and dividend payment are integral part of an organization. Firms manage their earnings and use them according to their desire. Dividend is distributed equally among all shareholders.
A dividend is a cash distribution by a company to its shareholders. Let's look at Al's ice cream shop. To open his first shop, Al gathers money from investors and issues shares. Al's ice cream is a hit and sales skyrocket. Al uses the company's profits to open up more and more shops. Soon Al reaches the point where his ice cream shops are competing with each other for sales. This is known as market saturation. Instead of opening more shops, Al decided to focus on keeping sales strong at his existing shops. Profits continue to roll in. Al now has the choice between investing his profits or simply paying them out to the shareholders. Al knows he can sell ice cream. He's not sure he can make a profit investing, so he decides to pay out some of his profits directly to the shareholders. He holds back some profits in case of an emergency and pays out all the cash he doesn't need to run his business. This cash is a dividend. It can be increased or decreased yearly according to how Al's business performs.
Dividend theories. There are several theories which try to look at the relevancy or irrelevancy of dividend payment. We shall discuss some of these theories. Dividend irrelevancy theory. This theory was proposed by Franco Motgliani and Martin Miller in 1961, who argued that the value of the firm is determined by the basic earning power and the firm's risk and not by the distribution of earnings. The value of the firm therefore depends on the investment decision but not the dividend decision. The argument was, however, based on the following assumptions: no corporate or personal taxes, no transaction costs associated with share flotation. The firm's investment policy is independent of the dividend policy. The market is efficient and therefore investors and managers have the same set of information regarding future investment opportunities. The bird-in-hand theory. This theory was advanced by Myron Gordon and John Littner in 1963, who argued that a bird in hand is worth two in the bush, and thus when a shareholder receives cash dividend, he is better off than one receiving capital gain. They concluded that dividend decisions are relevant and a firm that pays higher dividend has higher value. Tax differential theory. This theory was advanced by Litzenberger and Ramaswamy in 1979, who noted that the tax rate on dividend is higher than the rate on capital gain. A firm that pays dividend will therefore have a lower value since shareholders will pay taxes on this dividend. Dividend decisions are relevant and a firm that pays no dividend has the highest value. Signaling theory. Stephen Rose in 1977 argued that in an inefficient market, management can use dividend payment to signal important information to the market which is only known to them. If management increases dividend, it signals expected a high profit and therefore share prices will increase. Therefore, dividend decisions are relevant and a firm that pays higher dividend will have a higher value. The clientele effect theory. This theory was proposed by Richardson Pettit, 1977, who stated that different groups of shareholders have different preference for dividend. When a firm sets a certain dividend policy, there will be shifting of investors to it and out of it until equilibrium position is reached. At equilibrium, the dividend policy set by the firm will be consistent with the clientele it has. Therefore, dividend decision is an irrelevant decision, especially at equilibrium. Approaches to dividend policy. Corporations earn profits. They do not distribute all of it. Part of profit is plowed back or held back as retained earnings. Part of the profit gets distributed to the shareholders. The part that is distributed is the dividend. The following points emerge as regards the dividend distribution policy. The cost of equity is defined as a rate at which the corporation must earn on its equity to keep the market price of the equity shares constant. Equity shareholders are the owners of the corporation. Hence, retained earnings ultimately belong to the shareholders. Factors affecting dividend policy. The firm's dividend policy represents a plan of action to be followed whenever the dividend decision is made. The following factors which affect dividend policy. Legal constraints. Most states prohibit corporations from paying out as cash dividends and any portion of the firm's legal capital, which is typically measured by the par value of common stock. Other states define legal capital to include not only the par value of the common stock, but also any paid-in capital in excess of par. These capital impairment restrictions are generally established to provide a sufficient equity base to protect creditors' claims. Contractual constraints. Often the firm's ability to pay cash dividends is constrained by restrictive provisions in a loan agreement. Generally, these constraints prohibit the payment of cash dividends until a certain level of earnings has been achieved, or they may limit dividends to a certain dollar amount or percentage of earnings. Constraints on dividends help to protect creditors from losses due to the firm's insolvency. Internal constraints. The firm's ability to pay cash dividends is generally constrained by the amount of liquid assets available. Although it is possible for a firm to borrow funds to pay dividends, lenders are generally reluctant to make such loans because they produce no tangible or operating benefits that will help the firm repay the loan. Growth prospects. The firm's financial requirements are directly related to how much it expects to grow and what excess it will need to acquire. It must evaluate its profitability and risks to develop insight into its ability to raise capital externally. Owner consideration. The firm must establish a policy that has a favorable effect on the wealth of the majority of owners. One consideration is the tax status of the firm's owners. If a firm has a large percentage of wealthy stockholders who are in a high tax bracket, it may decide to pay out a lower percentage of its earnings to allow the owners to delay the payment of taxes until they sell the stock. A second consideration is the owner's investment opportunities. A final consideration is the potential dilution of ownership. Market consideration. An awareness of the market's probable response to certain types of policies is also helpful in formulating dividend policy. Stockholders are believed to value a fixed or increasing level of dividends as opposed to a fluctuating pattern of dividends. A final market consideration is informational content. As noted earlier, shareholders often view a dividend payment as a signal of the firm's future success. A stable and continuous dividend is a positive signal conveying the firm's good financial health. Types of dividend policies. The firm's dividend policy must be formulated with two basic objectives in mind: providing for sufficient financing and maximizing the wealth of the firm's owners. Three of the more commonly used dividend policies are described below. Constant payout ratio dividend policy. One type of dividend policy involves use of a constant payout ratio. The dividend payout ratio indicates the percentage of each dollar earned that is distributed to the owners in the form of cash. It is calculated by dividing the firm's cash dividend per share by its earnings per share. With a constant payout ratio dividend policy, the firm establishes that a certain percentage of earnings is paid to owners in each dividend period. Regular dividend policy. The regular dividend policy is based on the payment of a fixed dollar dividend in each period. This policy provides the owners with generally positive information, thereby minimizing their uncertainty. Often, firms that use this policy increase the regular dividend once a proven increase in earnings has occurred. Under this policy, dividends are almost never decreased. Low, regular and extra dividend policy. Some firms establish a low, regular and extra dividend policy, paying a low regular dividend supplemented by an additional dividend when earnings are higher than normal in a given period. Firms using this policy must raise the level of the regular dividend once proven increases in earnings have been achieved. The extra dividend should not be a regular event, otherwise it becomes meaningless. Other forms of dividends. Stock dividends. A stock dividend is the payment to existing owners of a dividend in the form of stock. Often firms pay stock dividends as a replacement for or a supplement to cash dividends. Accounting aspects. In accounting sense, the payment of a stock dividend is a shifting of funds between stockholders' equity accounts rather than a use of funds. When a firm declares a stock dividend, the procedures for announcement and distribution are the same as those described earlier for a cash dividend. The shareholder's viewpoint. The shareholder receiving a stock dividend typically receives nothing of value. After the dividend is paid, the per share value of the shareholder's stock decreases in proportion to the dividend in such a way that the market value of his or her total holdings in the firm remains unchanged. The company's viewpoint. Stock dividends are more costly to issue than cash dividends, but certain advantages may outweigh these costs. Firms find a stock dividend a way to give owners something without having to use cash. Stock splits. Although not a type of dividend, stock splits have an effect on a firm's share price similar to that of stock dividends. A stock split is a method commonly used to lower the market price of a firm's stock by increasing the number of shares belonging to each shareholder. Stock repurchases. In recent years, firms have increased their repurchasing of outstanding common stock in the marketplace. The practical motives for stock repurchases include obtaining shares to be used in acquisition, having shares available for employee stock option plans, and retiring shares. Cash dividends. Cash dividends are those paid out in currency, usually via electronic funds transfer or by paper check. Stock dividends versus cash dividends. Investors' preference for stock or cash depends on their inclination toward factors such as liquidity, tax situation, and flexibility. Income from dividends. Cash dividends provide steady payments of cash that can be used to reinvest in a company if the shareholder desire. Holders of stock dividends can sell their stock for high capital gains in the future, or they can sell it off immediately to get cash, much like a cash dividend. Cash dividends are immediately taxable as income, while stock dividends are only taxed when they are actually sold by the shareholder. If an investor is interested in long-term capital gains, he or she will likely prefer stock dividends. If an investor needs a regular source of income, cash dividends will provide liquidity. Firms can choose to issue stock dividends if they would like to direct their earnings toward the development of the firm, but would still like to appease stockholders with some form of payment. Deciding the dividend payout ratio. While dividend investing is a great way for investors to get a steady stream of return through income from their stock purchases, there are still certain signs that need to be examined to make sure investment is a smart one. One important metric to measure the reliability of a dividend stock is the dividend payout ratio. The percentage of earnings paid to shareholders in dividends calculated as Payout ratio basic. The dividend payout ratio is used to examine if a company's earning can support the current dividend payment amount. The statistic is simple to compute, calculated by taking the dividend and dividing it by the company's earning per share. Dividend payout ratio is equal to dividend per share DPS by earning per share EPS. Determinants of dividend payout ratios. Among factors that may be instrumental in affecting the dividend payout decision based on the literature, we can mention the followings. Corporate profitability. Corporate profitability has long been regarded as the primary indicator of a firm's capacity to pay dividends. Linter and Baker indicate that the dividend payment pattern of a firm is influenced by the current year's earnings and previous year's dividends. Cash flow. The cash flow position of a firm is an important determinant of dividend payouts. A poor liquidity position means less generous dividend due to shortage of cash. Tax. Tax-adjusted models presume that investors require and secure higher expected returns on shares of dividend-paying stocks. The consequence of tax-adjusted theory is a division of investors into dividend tax clientele. Sales growth. Sales growth may impact on dividend payout ratios. Dividend payout levels are not totally decided after a firm's investment and financing decision have been made. Rather, the dividend decision is taken along investment and financing decision. Market to book value. Market to book ratio reflects the market view of the value of equity in comparison to what shareholders have contributed to the firm since the day it was established. Debt to equity ratio. The debt to equity ratio is a financial ratio that indicates the relative proportion of equity and debt used to finance a company's assets. This ratio is also known as risk, gearing or leverage. Summary. Let us now summarize what we have learned in this session. It is an important decision that the manager must come across the firm earning management and dividend policy. The quality of earning is meaningful when different companies satisfy to manage their earnings with the help of the generally accepted accounting standard GAAP. The firm's dividend policy must be formulated with two basic objectives in mind: providing for sufficient financing and maximizing the wealth of the firm's owners. Equity shareholders are the owners of the corporation, hence retained earnings ultimately belong to the shareholders. The firm's dividend policy represents a plan of action to be followed whenever the dividend decision is made. Earning management and dividend payment are integral part of an organization.